Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's Friday, September the 26th, 2014. It's hard to believe, but we're approaching the end of the third quarter of 2014 already. I can't believe it. Now, on this update, I want to talk a little bit about currency moves, because from our perspective, that's probably been the most volatile area this year. Now, before we look at the actual currency moves, I always want to talk a bit about stock markets around the world and then sort of zero in on a few of the markets to give you a sense of what's been happening year to date. So we're taking these numbers as we have them today, as of today, for the course of 2014. So if you look at Europe, for example, overall Europe in terms of the stock markets haven't really moved anywhere this year. There's very little progress in the European markets. Germany, for example, is flat. In the UK, we've had about a 2% increase this year in the FTSE, they call it. That's the index that is in London. And so you look at the UK up 2%. Japan, if you go down to the Far East, is actually up 1% so far this year. And then if you look at the United States, the Dow Jones Industrial Average is up about 5% as we speak so far this year. But if you look at the smaller company index called the Russell Index, it's actually negative by about 3%. If you look at the technology index, or predominantly the technology index, the NASDAQ has done quite well. It's up about 8%. But when you peel back and look at the components of the NASDAQ, 47% of the companies on the NASDAQ exchange are down more than 20% year to date. So there's a lot of things going on underneath the surface within the various markets here. Now, in our own Toronto stock market, the Toronto stock market's up about 12% so far this year. Now, I want to swing over and look at currencies just very briefly, because in the currency markets, we've seen much larger swings, especially when you consider that currencies generally are going to move or should move a lot less than sort of stock markets. The euro, for example, is down relative to the US dollar, and all of these moves are relative to the US dollar. The euro is down about 6 to 7% so far this year, and most of that in the last 2 months. So there's been some big moves in the euro down. We'll come back to that in a second. The pound sterling is one of the only currencies that is up slightly against the US dollar this year. It regained some ground after the sort of the scare they had over in the UK with the recent Scottish vote, the vote on whether Scotland would succeed and leave the UK or whether they would stay. And when that vote came back that Scotland was going to stay, the pound did jump back ahead of the US dollar so far this year. The yen, the Japanese yen, as we've talked about, Japan is faced with just massive debt problems. The yen, which they're trying to devalue, is actually down more than 10% year to date against the US dollar. And so the stock market's done virtually nothing, and the yen is down over 10%. Now, the Canadian dollar, as most of us know, is down at this point year to date around 8%, and it's been very volatile. It gave up a lot of ground in the first quarter, gained some of that back in the second quarter, most of it, and it's given it all back again in the third quarter. So it's been very choppy. And so the story here is the US dollar, and the US dollar has been very strong so far this year, and in particular the last 2 months. If you think of poor old Russia and the situation there, the ruble, the Russian ruble, and some of the, when you look at the emerging market countries, many of the emerging market countries, they've seen their currencies drop by over 20% against the US dollar year to date. So big moves. Now, why is the US dollar going up and away, if you will? Well, the Federal Reserve, their big central bank, is talking about slowing down and stopping money printing. In fact, they have slowed down, and they hope to stop their money printing next month. So we're looking at October, November timeframe. They're also talking about interest rates actually going up. And so this is encouraging flows into the US dollar. When you look outside of the United States, if you think of Japan, which has seen a massive drop in their yen this year, they're actually mired in negative growth. There's no growth in Japan. And again, we've talked about this before. Aging population, you've got massive debt in that country. And so the yen relative to the US dollar, who would want to buy yen? When you look over in Europe, you see that Europe is mired again in a situation with virtually no growth across Euroland, and in fact deflation, so prices dropping. And if that's the case, the European Central Bank is going to have to step in. In fact, they've already mentioned that they're going to step in, and they're going to start potentially a QE program, quantitative easing, which is money printing over in Europe. So when you compare the euro to the US dollar right now, you say, why would I buy euros if I can buy US dollars? And hence, US dollars continue to go up. So this is an important move in the marketplace, and it does impact valuations. It does impact the different investments that we make. Now, the direct impact for Canadians is really felt in the commodities market. So this makes sense because all of the commodities are denominated and valued in US dollars. So if US dollars are going up in value relative to other currencies, then commodity prices generally come down. And that's exactly what we've seen across agricultural commodities, base metals, precious metals, energy. We've seen commodity prices coming off. Now, we don't have massive exposure to commodities. It's a tough area to invest. The only areas that we have any kind of significant exposure to would be in energy, oil, gas, and then in some of the precious metals, particularly silver and gold. And those are really there as a hedge against the debt problems in the world and against a monetary problem that could occur at any time. And so what are we doing in those areas? Well, in the energy area, we continue to hold great companies, very profitable companies, companies that pay very large dividends, and we're not fussed by the day-to-day volatility. Now, to be honest with you, the drop in the Canadian dollar has largely offset the drop in oil and gas, so that you don't feel the drop in oil and gas very much when our dollar is actually dropping. And so the stocks have compensated for that and are largely, flat over the last little while, off a little bit, but have hung in there quite well and continue to make lots of money and continue to have opportunities to distribute significant dividends to shareholders, so we stay put. The precious metals, if you think of the gold and silver markets, it has been one big roller coaster, up, down, up. And more recently, the precious metals have come off a little bit, although they're still trading at pretty good valuations. Our focus remains that in terms of this area, maintain 6-8% in portfolios. We've done some fine tuning in terms of our investments. Some of the clients will see that. We've really tried to make sure we're in the very high quality companies, the big royalty companies, the profitable mining operations. And so we are very well positioned in the precious metal space. We like the companies. And in fact, most of the companies we have in this space pay pretty good dividends now and are very cash flow generative and have no net debt. And so we stay to that area. As we've talked many times before, the world is a very risky place. The monetary conditions are weak, and you need to have yourself well hedged against some of those risks. So when we look at the U.S. situation now, yes, the U.S. dollar is going up, but don't forget that will put significant pressure on the U.S. economy, on U.S.-based companies that have to make money around the world. And in our view, over time, this will also make it very hard for the Federal Reserve to put interest rates up in the United States. And the reflation that is taking place around the world will eventually put more and more pressure on the US dollar and on the US economy for them also to step back in and to make sure their dollar doesn't go up too much, or they will become significantly uncompetitive in many of their industries. So when we look at all of the currency moves, all the things that you're seeing going around, what it really points to is global economic weakness. And the fact that the US dollar on a relative basis is a little stronger now, in our view, cannot be maintained over the long term without significant problems in the U.S. economy, which then will, of course, find itself back into the stocks and into the businesses. So, what does that mean? It means we remain focused on strong companies in essential industries, particularly hard assets that cannot be impacted or will not be impacted as much by reflation and aggressive monetary policy. So we continue to have significant positions in agriculture, in terms of the implement businesses and seeding and retail businesses in agriculture, not necessarily the commodity exposure, into water assets, into staples, well-run financials, technology businesses, precious metals, energy, healthcare. So again, we're trying to find great companies in a large number of industries that make sense for the long term. And we like the way we're positioned in the marketplace. We expect more volatility. We want more volatility in the marketplace so that, again, it will unearth and unlock greater values for us to deploy some of the cash and short-term investments that we have in investors' accounts. So there's a quick update on the current situation. Yes, a lot of moves in the currency markets, a lot more moves in the currency markets than in the stock markets. But at the end of the day, we are well positioned in the businesses that can absorb that volatility, profit from it, and take advantage of the challenges that are facing the global economy and will continue to face the global economy over the next number of months and years. One other note that I wanted to make is that recently the Ontario Securities Commission, which we report to directly, has set up what they call an ombudsman for the industry, and we'll put out more information on this, but I did want to mention it to our clients, and this is required by the Ontario Securities Commission, and this is a group of individuals who are involved in any dispute resolution. So if there's issues that arise between a financial advisor and client, then there's a mechanism that has been put into play that allows investors to go to the ombudsman and raise the issues that they might have against their advisor. And so we actually help fund this as a participant in the capital markets. We pay a fee towards that. And it's important that you know that this ombudsman has been set up for your benefit if there's issues. And we will provide you with more information pertaining to this in regards to our third quarter, and we'll also put the information on our website. Okay, so thank you very much for listening, and I trust that the third quarter has gone well for you, and you're looking forward to the final quarter of 2014. We'll be sending out a third quarter update shortly, and again, if you have any questions at all, please phone us, email, or stop by the office. Thank you very much. Bye now.